Okay, first we are going to start with investment decision. I'm going to start with investment decision. Whenever see, whenever you want, you make running notes. If I have to dictate something, I'll let you know, but otherwise focus will be on learning by understanding things rather than keeping on writing. Don't be on that focus, because your focus is just on writing things rather than learning it. So first chapter we are going to start is investment decision. Let me set the context of the chapter. If you look at ICI study material, you have only one chapter called investment decision. I have broken this into two. One is called time value of money and second is called investment decision. Reason for breaking it down is time value of money is something you learn at CA foundation, but it's extremely critical for me. So I will repeat whatever you learned earlier. I will go through maybe a 2 hour or 1.5 hour discussion on time value of money, because that becomes very, very critical, because that's the crux, like golden rules. That's the crux. So I will spend some time on time value of money area. It is not a separate chapter. It's not a separate chapter in your ICI study mat. ICI study mat has a chapter called only investment decision. So first, let's focus on time value of money. Then we'll focus on investment decision. Clear? Three books you have. You have question bank, you have concept book, and you have theory material. Theory material, I may not refer it in my class. Theory material, I may not refer it in the class. So I may not want you to bring even the theory material. Concept book, question bank, will keep shuffling between the two. We'll keep shuffling between the two. So let's go to the concept book now. Time value of money. Chapter 7A, time value of money, page 41. Okay, let's understand this first. Guys, let's understand what is time value of money. The worth of the money changes with time. The core concept of finance, the worth of money changes with time. Now let's understand. Rupees 100 today. Rupees 100 today, and after 2 years, same rupees 100. After 2 years, same rupees 100. I ask you that I give you two options. Either I can give you 100 rupees today, or I can give you 100 rupees after 2 years. 100 rupees today or 100 rupees after 2 years. Which one is better? Why today? Both are 100 only. No, what is the problem? Value increase. What is the decrease? Why is the decrease? Inflation will eat away the power of money. Inflation will eat away the power of money. See, when I was studying, I was able to manage with 5 rupees per day at that time. Now, obviously, 5 rupees per day is of no use, because the inflation has taken away the lot of value of money. Inflation has taken away the lot of value of money. My parents, when they were studying, even 50 paise was sufficient. Even 50 paise per day was sufficient. 40 years back, 50 paise had lot of value. Maybe 20 years back, 5 rupees had value. Maybe 10 years back, 50 rupees had value. And maybe today that 50 rupees is like 200 rupees. Lot of us may spend 50 rupees per day or 100 rupees per day or 200 rupees per day. Daily expense can even go to that level. Normally, easily it will happen. The reason is the inflation has eaten away the power of money. The inflation has eaten away the value of money or power of money. So 100 today, 100 let's look at this. I have 100 rupees today. Today it's worth 100. Tomorrow it will worth 90. Then it will become 80. Then it will become 70, 60, 50, 40. At some stage it will be like 0. 100 rupees would become, after 50 years, 100 rupees would be like rounding off. It will become like 0. It will become like 0, because the value of the money keeps going down. The value of the money keeps going down. If I want to preserve this 100 worth, then this 100 should become 110, 130, 150, 170, 200, 250, 300, 350. It should keep going up. It should keep going up. Does that mean value of money is going up? No, value of money is not going up. 100 is becoming 110 so that the value of 100 is preserved. 100 is becoming 120 so that the value of 100 is preserved. 100 is becoming 150 so that the value is preserved. You need to preserve the value of the money because inflation will eat away. Inflation will eat away the value of the money. If you want to preserve the value of the money, you need to invest the money. You need to invest the money. You cannot keep the money in your at your home saying that I'll keep 100 rupees at my home. 100 rupees after 10 years will become almost worthless. So if you create a fixed deposit, 100 will become 110, 120, 150, 180, 200, 250, 300. The value, the amount, the absolute amount will keep going up. Worth of the money did not go up. The worth is still 100 only. It's just the absolute amount which is going up. If the absolute amount cannot go up, if the absolute amount cannot go up, you are facing a situation where what is going to happen? The worth of the money is going to go down. 100 rupees was able to give me 1 kg of apple few years back. Today you cannot get 1 kg of apple with 100 rupees. That is what has happened because of inflation. Will that stop at any stage? No, it is not going to stop at any stage. This is a continuous exercise. What can be an inflation rate? How much inflation can be there in an economy? Okay, that's India. Can the inflation be more? How much can it be? What can be maximum inflation according to you? You tell me. No. 289%. Inflation is 289% in Argentina. So inflation can be as high as this number also. This economy is under a lot of trouble because of this inflation. But inflation can be even as high as this, which means if you have 100 rupees, you need to earn at least 300% on that to preserve the value of the money. To preserve the value of the money. What is 100 rupees a year back will become 400 rupees next year. If inflation is 289%. If inflation is 289%, 100 rupees will become 400 rupees and worth of 100 will become 25. And in next year it will become worthless almost. It will become worthless almost because what has happened? Inflation is very high. Inflation is very high. And that is why you would have learnt in economics managing inflation is very, very critical. Lot of actions are taken by RBI. RBI takes lot of action to control inflation and control interest rates because inflation if not controlled, low inflation is also a problem, very high inflation is also a problem. Somewhere a balance needs to be maintained. Clear? So the first concept is money value will keep going down, as time goes by. So I have to preserve the value of money. For preserving the value of the money, you have to increase the amount. I'm again talking about increase the amount, not the value. Value is not going up. 100 becoming 110 does not mean your value has gone up. 100 becoming 110 in a year means 100 values preserved at 100. 100 values preserved at 100 because what you were able to do with 100 today, you need 110 rupees a year later. So this is the concept. Money has different value. Money has different value based on the timing of cash flow. Somebody says, I'll give you 5,000 or 6,000. I give you two choices. Don't tell 6,000 is better. Ask the next question. 5,000 when? 6,000 when? 5,000 after 5,000 today or 6,000 after 5 years. If I give you two choices like this, many will choose 5,000 today. Many will choose 5,000 today or 6,000 after how many years? 5 years. Which means let me get 5,000 today, create a fixed deposit that will give me some 7-8%. This 5,000 in 5 years would have become 8-9,000. You cannot, somebody says which is better, you cannot give an answer saying 5 is better or 6 is better. You need the context of timing. Because the value changes based on what? Timing of cash flow. You will have a problem where I tell, is 5,000 better or 6,000 better? 5,000 today, 6,000 2 years later. You don't know which is better. So to understand which is better, Either I convert the 5,000 to after 2 years, or I convert 6,000 to today. I convert 6,000 to today. How you do that conversion is this chapter. How you do that conversion is only this chapter. The purpose is to convert what will this 5,000 be after 5 years, or what will that 6,000 be today, so that I can compare two options. So that I can compare two options. I'm going to do a project. I'm going to do a project. Project year 0 you have to spend 100 crores. First year you will get 50 crores, second year 40 crores, third year 20 crores, fourth year 50 crores. You cannot just do a simple addition. You cannot do a simple addition and say that project is viable, because 100 crores was spent today and you're getting 50 crores a year later. The value is different. 40 crores 2 years later, 30 crores 3 years later, 20 crores 4 years later, 10 crore 5 years later. There is a different value for each of this. That adjustment is what this base chapter is doing, so that I do that adjustment when I go to investment decision. When I go to investment decision, I'm able to do these adjustments. Clear? Any doubts on this? So it says 100 received today is greater than what? 100 a year later. 100 received today is greater than 100 a year later. Obviously 100 today is better than 100 a year later. Next, the time value of money. The time value of money is what? Reward. Reward for what purpose? Postponing the consumption of money. Postponing the consumption of money. I have 100 rupees today. I can use it, or let's assume I have 1,000 rupees today. I can use it and go for a movie. I can use it, go for a match. I can use it, buy a book, whatever I do. If I'm postponing this 1,000 should at least become 1,050 or 1,100 or 1,200, because I put this in a fixed deposit. I am postponing the consumption of money. Two things ideally a person should do. If you have money, either consume it or invest it. You don't tell me I'm saving the money and putting it in at home. That is not saving. That is waste of money. That is waste of money. So some cash we keep it, but beyond a point, keeping a cash is of no use, because if you keep piling up cash at home, and the value of the money is only going down. The value of the money is only going down. So you are postponing your consumption, but also not getting that reward. Also not getting that reward. You will unnecessarily waste money. You are unnecessarily waste money. So what is interest rate? Practically interest rate has three things. Inflation. What is inflation? The increase or decrease in prices. If inflation is going up, interest rates will go up. That is what RBI keeps doing. RBI, through its monetary policy, if inflation goes up, they'll increase the repo rate. If inflation goes down, they'll reduce their repo rate. So there is a link between interest rate and inflation rate. After inflation, if you earn anything more, that is called real return. That is called real return. Somebody will say, I earn 8% from fixed deposit. No, you're not earning 8%. You're earning only 0.5% or 1%. You're earning only 0.5% or 1%, because inflation is taking away the money. Inflation is taking away the return. What are you earning beyond inflation? What are you earning beyond inflation is the critical part. How much beyond inflation? How much beyond inflation? Clear? Any doubts on this? That's called real return. That's called real return. The real return can be earned on 2-3 instruments. One is called risk free. What is risk free? Is something which does not carry any risk. For example, I ask, give me a loan. Give me a loan. Technically, giving a loan to me is a risky proposition. Why risky? Is basically you are not sure whether I'll return the money or not. So you can have some confidence and all, but still that uncertainty is there. What is risk free? If I put it in government bonds, if I put money in government bonds, it is expected that government will not fail. Government is going to return my money at any point of time. Government is going to return. So government security is called risk free. Government security is called risk free. Our mind always thinks this way. If risk free is giving 7 and you want to give it to some risky person, it has to be more than 7. It has to be more than 7. If government is giving you 7, when you give a loan to me, you will ask, give me 10, 11, 12, 13, 14, something more than 7. Something more than 7. That extra is called risk premium. That extra is called risk premium or return premium. Risk premium or return premium. What is risk premium or return premium? Is extra which you need. Extra which you need. Clear? Any doubts on this? The first concept, time value of money, is basically a concept which says I am postponing my consumption of money. If I am postponing consumption, please give me some reward. What is the reward I want? First, inflation. Second, real return which the government is giving. And third, on top of it, you give me something extra. On top of it, give me something extra depending on where I'm investing the money. Where I'm investing the money. Clear? Any doubts on this? Any doubts on this? In that, now let's come to the first concept, future value. What is future values? Future values tomorrow's value of today's money. Tomorrow's value of today's money compounded at time value of money. We do something called as compounding. We do something called as compounding. Now what we do here is present value 10,000. Present value 10,000. There's a present value which is 10,000 and I'll get future value. What is future values? This is year 0. What should be this in year 2? What should be this in year 2? Let's assume bank will give me an interest of 10% in the calculator. Do 10,000 plus 10%, 10,000 plus 10% plus another 10%, 12,000. Ideally, 10,000 should become 12,100 in 2 years. 10,000 of today should become what? 12,100 in 2 years by adding what? 10%. I told 10%. Somebody may say, no, I don't want 10%. Give me 12%. Then your answer will change. Your answer will change. Different people have different expectation on time value of money. What is 10% for me? What is 10%? The return which I want. What is return? Inflation, real return, plus the risk premium, plus the risk premium. Somebody will say, no, 10, add 12. Can you do 10,000 plus 12 plus 12? Plus 12 plus 12, tell me the number. For somebody, 10,000 is equal to 12,100. For somebody, 10,000 is equal to 12,100, and for somebody else, 10,000 is equal to 12,544. 10,000 is equal to 12,544. This is called compounding. This is called compounding. Present value compounded and you get future value. I'll come to formula and all later. Then I want to go in the back order. This is called discounting. In the calculator, 12,100 divide by 1.1. Again divide by 1.1. What is 1.1? Is 1 plus 10%. The rate of interest was 10% divided by 1.1. 1.1 in the calculator, 12,544 divide by 1.12, again divide by 1.12, 10,000. Clear? Any doubts on this? In the calculator, 10,000 into 1.12 into 1.12, 12,544. So if you want to do compounding in the calculator, you can do plus plus, or you can do into 1 plus the interest rate. You can do into 1 plus the interest rate. And if you want to do discounting, you'll have to divide by 1 plus the interest rate. Divide by 1 plus the interest rate. Either multiply with 1 plus the interest rate or divide by 1 plus the interest rate. This is what we are going to do. This is what we are going to do. Either multiply with 1 plus the interest rate or divide by 1 plus the interest rate. Clear? Any doubts on this? Compounding means present value taking it to future, and this is future value taking it to present. Future value taking it to present. Any doubts on this? Any doubts on this part? Tomorrow's value of today's money. Tomorrow's value of today's money compounded at time value of money. Compounded at time value of money. The formula is what? Into 1 plus r whole power n. When I told you, what did I say? 10,000 into 1.1 to 1 time. Again into 1.1 to 2 time. That is square. If you do 3 years, power 3. 4 years, power 4. 5 years, power 5. 6 years, power 6. You can keep doing any number of years. You can keep doing any number of years which you wish to. Any doubts on this? Any doubts on this part? Now, let's take this example. Write along with me, okay? Examples, you can write along with me. Ram has deposited 55,650 in a bank which is paying 15% rate of interest on a 10-year time deposit. Calculate the amount at the end of 10 years. Calculate the amount at the end of 10 years. This is the requirement. We will capture certain basic information. For FM, I think one note is also sufficient. That is same note. You can write theory practical together itself. No separate theory note I'm telling you to mention, because my concept book has a lot of things properly covered, so I don't need a separate note. When you do, in case you want to make certain notes, some important notes you want to make, in the same notebook, in the reverse page, it will be max 5-10 pages of notes you will be making on your own. In case you want to, in the reverse order, in the same notebook you will do it. Otherwise you will keep solving it in one book itself. Let's start this. Basic information. See, whatever I'm going to tell you now will give you the base concept, and I'll tell you at final level, students still make mistakes in time value of money. It may look very simple, but still people make mistakes on this concept even at final level. So understand the importance of this. Be very clear what I'm explaining, and this is like golden rules of financial management. This is like the golden rules of financial management. Full clarity needs to be there, because I explain all this. One problem you will see, they'll say in year 2 you receive this amount, in year 4 you receive this amount. What you do, you are adding 2 and 4. Cannot be added. It cannot be added, because they are not at the same point of time. They are not at the same point of time. All this has to be there at the back of your mind, saying that whenever you tell me to add certain numbers, they should be for that time period. If they are a different time period, bring it to same time period by doing compounding or discounting. Point number 1, present value. Year 0. The question has mentioned 55,650. I am depositing today. Rupees 55,650. What is the question asking? Amount at the end of 10 years. Amount at the end of 10 years means future value. Future value, question mark. Future value, question mark. Rate of interest. How much? 15%. Rate of interest 15%. Time period 10 years. Time period 10 years. Let's do future value is equal to, just give me a minute. Okay, future value is equal to present value into 1 plus r the whole power n. 1 plus r the whole power n. Same formula will do it for present value in the reverse order. What is the present value given in the question? Into 1 plus what's the rate of interest? 0.15, 15%, 0.15. How many years? In the calculator, first get me this. 1.15 power 10. 1.15 into 1.15 into 1 power 10 I want. 3 decimal. 04. Whatever it is, whatever the number you get, I'm not really interested in that. Whatever number you get, it is 1.15 power 10 4.046, 0456 it is, so 046. Do multiplication. 55,650 into 4.046. 2 lakh 119. 55,650 into 4.046. Sorry, no, sorry. 225 160. 55,650 only, no? 225 160. Any doubts on this? This is called compounding. This is called compounding. Any doubts till this? What we have done is we have multiplied with the 1 plus r the whole power n. If you divide by 1 plus r power n, it will become discounting. It will become discounting. How will it become discounting? You will say this goes the other side. Fv divided by 1 plus r the whole power n is equal to present value. Future value divided by 1 plus r the whole power n is equal to what? Present value. So if you want present value, divide by this. If you want future value, multiply with this. Any doubts till this? Okay. Now, some question will give something like future value factor. They may give this factor directly in the question. What is future value factor is? Future value interest. Future value interest for rupees 1 for a period at I percentage for n periods. What is the rate of interest we have? Okay, I'll go to the next page. 15%. What is the number of years we have? 10 years. So directly they may give this 4.046. Directly they may give this 4.046 instead of you doing in the calculator. Below the question, they will say future value factor is 4.046. If it's 4.046, I'll multiply with 4.046. That's all. So this tables I have given it in the question bank, page 338. No need to refer as of now. But in case the question gives it, use it. If they don't give it, then you do calculation in the calculator. You'll have to do calculation in the calculator. Now, right, alternate answer. Alternate answer. The answer is going to remain same only. Alternate answer. Future value is equal to present value into future value factor r comma n. Future value factor r comma n. That's how we write it. FVF r comma n. This is how we write it. What is the present value? Into FVF, future value factor. What is the rate of interest? Comma. So what question can do is they will say FVF in bracket 15% comma 10, 10 comma 15. They may give multiple things. What I want is 15% comma 10. What I want is 15% comma 10. 10 comma 15%, sorry, 10% comma 15 is different. Okay, I want 15% comma 10. If they give me that, I'll use it. If they have not given, let's not worry about it. Do it in the calculator and then close it. Do it in the calculator and then close it. Same answer you'll get. Future value is equal to 55 650 into 4.046 into 4.046. Any doubts on this? Clear? Can we proceed? Any doubts on this calculation? Done? This is first segment of the analysis, that is I want to take my today's value to a future period. Why I want to take? Multiple reasons can be there. I give you a choice saying that I'll give you 5,000 today or 25,000 after 10 years. So you want to take this 5,000 after 10 years, how much it is? You want to calculate after 10 years what is the worth of this 5,000. That is analyzing through future value. You can also analyze through present value. What is present value? That 25,000 you bring it to today. That 25,000 you bring it to today. What we have done in this question is, it was like this. This is the data 55 650 year 0. What is it in how many years was that? 10 years. What was the answer you got? 25. This is what you have done. This is called present value. This is called future value. Present value and future value. You have taken this value to future. If you want, you can take the future value to today, which is the next concept. Any doubts on this? So Ram deposited 55,650. You got two. I've done 4 decimals. That's okay. Let's not worry about the decimal. We normally work with 3 decimal. We normally work with 3 decimal. That's how we normally do it. But if you increase the number of decimal, accuracy improves. Then present value is today's value of tomorrow's money. Today's value of tomorrow's money discounted at time value of money. Discounted at time value of money. Here I'm employing the discounting technique. There I'm employing what? Compounding technique. Compounding means value will go up. Again, understand the importance. Value, worth is different. It's absolute amount which is going up. There is no improvement in the per se value of that money. It's just that the amount which is going up. The worth remains the same original value only. The worth remains the same original value because of inflation. Because of inflation. Present value is today's value of tomorrow's money. Present value is equal to future value into 1 divided by 1 plus r power n. Or in simple words, it is future value divided by, why I am writing this separately is 1 divided by 1 plus r power n is called as present value factor. 1 divided by 1 plus r power n is mathematically called as, or is technically called as present value factor. Like I showed you future value factor now, I'll show you present value factor tables later. Let's take the example. Suppose you have celebrated your 19th birthday. A rich uncle of yours has set up a trust fund that will pay you 2,50,000. That will pay you 2,50,000 when you turn 30. If the time value of money is 9%, how much is the fund worth today? How much is the fund worth today? I am required to find out what is the worth today. Let's first put a diagram for this. Put a diagram in the side. Day 0. Is a question mark. I don't know the value. Day 0 is the question mark. I don't know the value, which is why I'm calculating present value. How much is the fund worth today? As you turn 30, you'll get how much? 2 lakh. So I need to discount this to today. I need to discount this to today. I need to discount this to today. How will you do discounting? Divided by 1 plus r the whole power n. Divided by 1 plus r the whole power n. That will do discounting. That will do discounting. Compounding into 1 plus r the whole power n. Discounting divided by 1 plus r the whole power n. Any doubts on this? Clear? Now write the basic data. I'll keep writing it. It is anyway extra time, but that's okay. Initial questions, let's get full clarity. Present value, future value, rate of interest, time period. What is the present value given in the question? Okay, question mark. Future value, rate of interest, number of years. Think 11, 12, 10. Think and let me know. You may be right also. I'm 11 years, 12 years, 19th birthday is over. So 19 is completed. 20, 21, as you do the counting, you'll find it is 11 years. 11 years. Present value is equal to future value divided by 1 plus r the whole power n. Divided by 1 plus r the whole power n. What's the future value? I'll write it separately like this. 1 plus, what's the rate of interest? 9%, 0.09. Yeah, write it as in decimal only. 0.09. How many years? 11 years. It is 11 years of analysis which needs to be done. Now what you do in the calculator, do what I say, 1 divided by 1.09. Okay, you got a number, put another equal to. So listen, 1 divided by 1.09 equal to is the first year number, second equal to second year number, equal to third year number, equal to fourth year number, equal to fifth year number, equal to sixth year number. This approach will not work in few calculators. Again, request is very clear, if it's not working in your brand of calculator, you'll have to change the calculator, otherwise it will take away a lot of time in finance, lot of time I'll get wasted. 1 divided by 1.09, put a equal to, again a equal to, again a equal to, 11 times if you put a equal to, you'll get a number. That number is what I'm looking at. Do in the calculator from the beginning. 1 divided by 1.09 equal to first year number, equal to second year number, equal to third year number, equal to fourth year number, equal to fifth year, equal to sixth year, equal to seventh, equal to eighth, equal to ninth, equal to 10th, and equal to 11th. Tell me the 11th year number. 0.3875. Multiply with this 3875 and close it. Multiply with 3875 and close it. Multiply with 3875 and close this. How much? Okay, clear. Any doubts on this? Any doubts on this? I'll come to again come to that calculation. Listen for some time. Now let me look at this present value interest factor. Okay, listen. In the calculator, 1 divided by 1.05. Do 1 divided by 1.05. Are you getting 0.952? Another equal to 0.907. Another equal to 0.864, another equal to 0.823. If this is happening in your calculator, it's okay. If it's not happening, please change it. Please change it to a brand where this works. Else you will start struggling, because lot of places, I'll keep telling you, because when we solve a problem, a lengthy problem, I will need first year factor, second, third, fourth, fifth, sixth, seventh, eighth, ninth, 10th. I'll need multiple years. You cannot keep doing it differently and then keep getting to an answer. In few brands, it does not work. If it does not work, please change it. Please change it. Look at your friend where it works. Get to that brand, whichever it's working. Okay. Any doubts on this? How you get present value factors? 1 divided by 1.05 equal to. You can keep putting equal to and do. In this question, what was the number of years? What was the rate of interest? 9%, and you would have got this as the factor, 0.388. You would have got 0.388 as the factor. 388, you got 3875, that's rounding off. That's the rounding off. So many questions, they will give you this present value factor. They'll give you this present value factor, which is point. Normally 3 decimals is what we work. Normally we work with 3 decimals. You increase the number of decimal or reduce the number of decimal, accuracy will improve. Any doubts on this? Any doubts on this? So present value factor in the calculator, 1 divided by, or you could have also done it as 1.09 into 1.09 into 1.0. That takes more time. That takes more time. Get that number. 1 divided by that number you do, you'll get the same 0.388. You'll end up getting the same answer. Whichever approach you follow, final answer is going to remain same. Final answer is going to remain same. Now, alternate way of writing this, right? Present value is equal to future value into present value factor. Future value into present value factor in bracket r comma n. R comma n. There are a lot of questions where this will be readily given to you, so you'll have to directly take it rather than spending time on it. What's the future value in this question we did? Into PVF. What is the rate of interest? Number of periods. That was 0.388 from there. That you take it as 0.388, do multiplication and close it. 2,50,000 into 0.388. Into 0.388. Earlier answer could have been slightly up and down. You did 4 decimals. See, depending on the number of decimals, answer will change a little bit. Any doubts on this? So here I've gone through the division root of 2.580. Okay. And I shown you multiplication of 0.3875. Both are mathematically same. Both are 1 divided by 2.580 so much. 1 divided by 2.580. So you would have got the other factor. Inverse of future value factor is present value factor. Inverse of present is future. 1 divided by, you're not getting the number, 1.09 power 11. You will have to do that calculation. You will have to do the calculation. 1.09 power 11 is 1.09 into 1.09 into 1.09. You will have to do that calculation and get that number. So I'm saying basic thing is you can do this way, you can do division way, you can do multiplication way, you can do it through present value factors, you can do it through future value factor. In the end, my answer is going to remain same, whichever approach I do. Clear? Any doubts on this? Any doubts on this? Done? Yep. It will cause, as you proceed, I'll later tell you what we do for rounding off. It will cause a difference. It will cause a difference. Let's not worry about as of now. Any doubts? Clear? Okay. Let's take a break of 15 minutes and then resume. Okay. Now, in the examples which we have seen till now, we have understood how one present value is converted into future value, how one future value is converted into present value. Like this, what an organization may do is they may have multiple cash flows happening. It's not necessary that there is only a single cash flow, and they may ask us to calculate the future value of this multiple cash flows. How is that happening? Let's understand this. Cash flow at different points of time cannot be added because money has time value. 100 of year 0 plus 100 of year 1 plus 200 of year 2 plus 300 of year 3, you cannot add them together. You cannot add them together because there is a time value angle. There is a time value angle. We should bring all the cash flow either to day 0, bring everything to day 0, that's called discounting, or take everything to maturity value, which is called compounding. You either bring it to today or you take it to future and then put a total, that's called present value or future value. Let's see an example. Now write this example. Year cash flow. Year and cash flow. You may need extra, totally 6-7 columns you will need. 1, 2, 3, 4 and 5. Year cash flow. Year cash flow. Now I want to take this to the future value, or I want to bring it to today's value. The question wants to know what will be the value of these 5 in year 5, or what will be the value of these 5 today. These 5 today. Let's understand. I want to calculate future value. No need to write. Listen. If you want to calculate future value, this 20,000 will be multiplied with 1 plus, let's assume 10%. Okay. Let's assume 10% power 4. Why power 4? From year 1 you're taking it to year 5. From year 1 you're taking it to year 5. So we are doing power 4. The second one, 25,000 into 1 plus 10% power 3. Power 3. 25,000 you're taking it to, from year 2 you're taking it to what? Year 5. The next one, 30,000 into 1 plus 10% power 2. From third year you're taking it to the fifth year. This is 35,000, 1 plus 10% power 1, and technically it is same number, but mathematically I can say power 0. Power 0 means it's into 1. Power 0 is technically into 1. So 20,000 plus 4-year factor, then 3-year factor, then 2-year factor, then 1-year factor, and year 0 factor. This is what the numbers are. I'll give you time to write, be in listen mode for some time. Power 4, power 3, power 2, power 1, and power 0. Now we call this as future value factor. We call this as future value factor. In the calculator, listen, 1 into, do 1 into 1.1. You will get the same number, but do 1 into 1.1. Again do into 1.1. 1 point. Again do into 1.1. 3, 3. Again do into 1.1. 4, 6, 4, 1. These are my future value factors. I have written it in the reverse order because it is 0, 1, 2, 3, 4 in the reverse order. It's 0, 1, 2, 3, 4 in the reverse order. It's year. Year 0, year 1, year 2, year 3, and year 4. These numbers, I can take it from the tables which are there also. I can take it from the table. Go to the question bank and last few pages. 388 or 389, whatever last. What's the page number? Question bank 339. Come to 339. Come to 339. What is the rate of interest? Sorry, 338. 338 future value factor. What's the rate of interest I had? 10%. Here I have the factor you see. First year factor, second year factor, third year factor, fourth year factor. First, second, third, and fourth, and which is what I've written 1.1, 1.21, 1.331, 1.4641. In the reverse order, I've written it. In the reverse order, I've written it because today's year 1 is brought to year 5, second year brought to year 5, third year brought to year 5, fourth year brought to year 5, fifth year is already year 5 only. Fifth year is already year 5. Wait for some time, and this is called future value. What is future values? 20,000 into this, 20,000 into this. That is cash flow into the future value factor. Cash flow into the future value factor are technically the formula is present value into FVF. Present value into future value factor. Mathematically, I have written here 20,000 into this, 25,000 into this, 30,000 into this, 35,000 into this, 40,000 into this. So I put a total here, and you can write this in a minute. What this means is somebody is saying I'll give you 20, 25, 30, 35, 40. I tell him don't give me all this. Give me 1,77,357 at the end of 5 years, single amount. Give 177,357 single amount at the end of 5 years, and not simple total. If you put it is only 1,50,000. No simple total. It is compounding. It is compounding. You cannot add 20 plus 25 plus 30 plus 35 plus 40. Somebody says I'll give you 20, 25, 30, 35, 40 or a single amount 1,60,000. Don't say 1,60,000 is better. It is 1,77,000. It is 1,77,000. Just don't put a normal total. Putting a normal total is of no use. You cannot put a normal total. You will have to compound it or discount it and put a total. Compound it or discount it and put a total. You can do compounding if you want to value the at the. So for example, somebody is saying I'll give you 20, 25, 30, 35, 40. Instead of that, I'll give you a single amount today. Then I'll try to calculate the present value. I'll try to calculate the present value. Or I'll give you a single amount at the end of 5 years. I'll calculate the future value. It said at the end of 5 years. Maybe at the end of 10 years I want to calculate. If you want to do at the end of 10 years, year 1 value taking it to year 10 is power 9, power 8, power 7, power 6, power 5. You can keep doing any calculation you wish to. You can keep doing any calculation you wish to. From today, you can go to future. From future, you can go to today. From year 1, you can go to year 2. From year 2, you can go to year 1. From year 3, you can go to year 5. From year 5, you can bring it to year 6. Whichever year you want, you can do it. Only thing is, if you want from year 1 to year 5, compound it for 4 years. From year 5 to year 1, discount it for 4 years. Year 5 to year 2, discount it for 3 years. Year 2 to year 10, compound it for 8 years. You can do anything you wish to. Here, I'm taking everything to year 5. I'm taking everything to year 5. So I'm compounding for 4, 3, 2, 1 and 0. 4, 3, 2, 1 and 0. Write this now. This is compounding. Then I'll come to discounting. write this power 4, power 3, power 2, power 1 and power 0. If there are doubts, let me know. Whichever way you want it. This is just a formula for your better understanding. Initial set of question, I'm going little detailed calculation. Later on, we'll only write the FVF. See, this is like 5 different questions. Initially, you did one question future value. These are like 5 different problems. For every cash flow, I'm calculating the future value. Power 4, power 3, power 2, power 1 and power 0. So this is a very powerful concept to be clear on, because practical utility is very high. For example, your parents are coming and asking you that we will create one FD in year 1 of 20,000, second FD of 25,000, third FD of 30,000, fourth FD of 35,000, and in year 5 I'll get another 40,000. Can you tell me what will all this become in year 5? What will all this become in year 5? That's a requirement, they give it to you. That is what we have done here. That's a requirement. Basically, the 20,000 is an FD created. It's an FD created which earns 10% every year. Which earns 10% every year. Second FD earns 10% for 3 years. Third FD for 2 years. Fourth FD for 1 year. And fifth FD does not earn anything. They may ask you any type of questions like this. There's a lot of practical application. It is a lot of practical application which can come, because I want to know this. I want to know this, and you will have to answer this. So they are asking you this scenario and you need to calculate and give them. Any doubts on this? Can we proceed? Any doubts on this? Write the same example again. Let me do present value separately. I want 3 more columns. Space will be an issue. Year cash flow, present value, right? Present value factor and present value. Like we did future, we are going to do now present. We are going to do present. Like we did future value calculation, we are now going to go back and get present value. What is going back? From year 1 taking it to what? Year 0, discount by 1 year. From year 2 taking it to year 0, discounted for 2 years. From year 3 taking it to year 0, discounted for 3 years. From year 4 take it to year 0, discounted for 4 years, discounted for 5 years. So this is 20,000, right? Divided by 1 plus 10% power 1, power 2, power 3, power 4 and power 5. Discounting. I am taking it back. I'm taking it back to today's value. I'm taking this back to today's value. Taking it back to today's value involves discounting. Taking it to a future period involves compounding. Any doubts on this? If there are doubts, let me know. Is there a doubt? Because from year 1, I'm going to year 0. Year 1 value, I'm taking it to year 0. See, the concept is very simple. You have a year 0 here, you have a year 1 here. If you want to go forward, you will do into 1 plus r power 1. If you go backward, you will do 1 plus r power 1, but division. You will have to divide it. If you're going from year 0 to year 1, 1 year compounding or 1 year discounting. Year 0 to year 2, 2-year compounding or 2-year discounting. So are we going from which year to which year? You will have to check. For example, earlier, this you are taking year 1 to year 5. From first year you are going to fifth year. So power 4 I told you. Second year to fifth year, power 3. Third year to fifth year, power 2. Here from first year you are going to year 0. From first year you are going to year 0, 1 year discounting. Second year to year 0, 2-year discounting. Third year to year 0, 3-year discounting. Like this will keep going on. Now in the calculator, 1 divided by 1.1. Again equal to, just give me a minute, 1 divided by 1.1. First is 0.909 equal to what you said, point. Again equal to, again equal to, again equal to 6 to 1. This is how we'll write the factors. This is how we'll write the factors. Sorry? Yeah, sorry. The amounts are different. That's a copy paste error. 25,000, 30,000, 35,000 and 40,000. 20, 25, 30, 35 and 40. Now listen. If you are writing 0.909, you have already done the division. You have already done the 1 divided by this number is already done. So multiply 0.909 with 20,000. 0.909 with 20,000. Wait for a minute. 18, 180, 909 into 20,000 or both are mathematically same only. 20,000 divided by 1.1. The difference is rounding off. The difference is rounding off. 20,000. You want to divide by 1.1 and write, please write it. I have no problem. Or do present value factors and multiply with the present value factor. See, be it present value factors or future value factor, both will ultimately be multiplied only. Both will ultimately be multiplied only. When you are calculating this, you are doing division. When you are calculating this, we are doing division. And when we are calculating this, we are doing multiplication. We are doing multiplication. I'll repeat again. 1 divided by 1.1 in the calculator, do 1 divided by 1.1. Repeat again. Divide by 1.1. You got what? 0.909. Again equal to. Again equal to. Again equal to. Again equal to. I find discounting easier to do in the calculator rather than doing compounding. That is why I do 1 divided by, keep writing the values and then do multiplication and then do the multiplication. Then do the multiplication and put it out. Put a total. All of this you could have seen it earlier, but I just wanted to be very clear because these are core concepts for me. Now, why have we done this two analysis? Let's understand. Any doubts on the numbers? Now, let's assume somebody says, we will not give you this. We will not give you this. The total of this was 1,50,000. Will not give you this. Will give you a single amount of 1,60,000 in fifth year. Will give you a single amount of 1,60,000 in which year? Fifth year. We are very happy that 1,50,000 is the total and is giving 160. Let's just understand normal thinking. 1,50,000 was the total and is giving how much? 1,60,000. But that's the wrong comparison. That's a wrong comparison. You should compare 160 with what? 1,77,357 and say no. If you want to give me a single amount, give me 1,77,357 or higher. Give me 177,357 or higher. Clear? Any doubts on this? Any doubts on this? I'll explain again. I went to this. This is an investment product. Let's assume the product says we will not give you 20, 25, 30, 35, 40. We'll give you a single amount. And what is that single amount? 1,65,000. That is, I give you two choices: 20, 25, 30, 35, 40 or 160. You did total, said 150, 165. You are very happy, took 165. You are very happy and took what? 165, which is a wrong decision. Which is a wrong decision because you have not understood time value of money. You have not taken the time value of money into picture. It's a very critical product to make any decision. It's a very critical item to make any decision. If I just put a normal total, it's 1,50,000. He is saying he'll give me 165, but I want 177,357. I want 177,357. 165 not happy, 170 not okay, 175 not okay, 177 not okay. Minimum 177,357 if you're paying when? Year 5. Then he came, no, I don't want to get into this. Then what he said, you again put a total in your mind and you said 1,50,000. He says, I'll give you 1,20,000 today. I'll give you 1,20,000 today. You are saying nothing doing. It is total is 1,50,000. Why are you giving me 120? Without knowing time value of money, you put a total and said 150, and you are giving me 120. I'm not okay with it. I'm not okay with 1,20,000. Whereas I should have been very happy because this worth is what? 1,10,000. If you are giving me today, minimum I need is 110 and not 150. And if you're giving me later, I need 177 and not 150 and not 150. 150 is just a normal addition. 150 is just a normal addition. 150 keeping in mind is of no use. So if you're giving me 160 after 5 years, I'm not okay with it. And if you're giving me 120 today, I'm very happy about it. 120 today is a very happy thing because 120 is better than what? 1,10,105. Today minimum I need 110. Later minimum I need is 177,357. This is what time value of money is doing. This is what time value of money is doing. Any doubts on this? Any doubts on this analysis? Clear? Can we proceed? This crux, it has to be very clear to you. Any doubts? Any doubts on this? Can we proceed? You want me to explain again? I'm ready to explain it again. If it's not clear, something is confusing to you, let me know. I'll explain again. Anything not clear? Can we proceed? So cash flow at different points of time cannot be added because money has time value. We should bring all cash flows either to day 0, which is called discounting, or to maturity date, which is called compounding. This is an example where I've done compounding, and another example where we have done discounting. Both have been done. Not very difficult for you to understand. I've given a very complex example and done it. Any doubts on this? Any doubts on this part? Can we proceed? Okay, next comes an example of annuity. Next comes an example of annuity. What do you mean by annuity? Sorry? What is the meaning? EMI, I don't understand. So tell me what is, sorry? Series of payments at a regular periodicity. Series of payments at a regular periodicity is called annuity. Series of payments which will come regularly, Example, year 1, year 2, year 3, I'll get 10,000. If I'm going to get 10,000 every year, it is called annuity, same amount. Year 1, 10,000, year 2, 25,000, year 3, 10,000 is not an annuity. It's not a annuity because you're not getting the same amount. You're not getting the same amount. Year 1, 10,000, year 2, 10,000, year 3, nothing, year 4, 10, year 5, 10, year 6, 10. Again, not an annuity. Annuity means same amount and same periodicity. Every year, it can be every month also. It's not every year, it can be every month also, every quarter also, every year also, every half year also. But that specific periodicity is to be maintained. The specific periodicity is to be maintained. Clear? Any doubts on this? Now let's understand an example. Here I did know. Let's take 20,000. It's the same 20,000 for all the 5 years. It's the same 20,000 for all the 5 years. Okay, same 20,000. Earlier I said 20, 25, 30, 35, 40. Future value is 122, 102. Future value is 122, 102. This number I am going to get without doing the table. I'm going to get without doing the table. That is the purpose of annuity. That's the purpose of annuity. Similarly, I have 20,000 here, no? This 7,500, I'll get it without using the tables, without doing the tables, using a simple calculation, If you do every year calculation like this, it becomes a normal problem. But if it's the same amount every year, I have a shortcut approach. I have a shortcut approach. That is what we are going to analyze in annuity. Annuity means equal receipt or payment, equal receipt or payment at the beginning or end of a specific period, at the beginning or end of a example. Rent is an annuity. Rent is a annuity. The basic classic example is rent has to be paid every month. Rent has to be paid every month. Unless there is a change happens in the rent, it remains annuity. Rent changed, again it becomes an annuity now of a higher amount. It becomes of a higher amount. Rent is a very good example of an annuity. Clear? So 20,000, 20,000, 20,000. One approach is doing this, which is very time consuming, Now first let me close present value in the calculator. 1 divided by 1.1 equal to, again equal to, 5 times you press equal to. I'll repeat, 1 divided by 1.1 equal to, equal to, equal to, equal to, equal to, 5 times press it and press GT button. If GT is not there, I'll give you the other option. If GT button is not there, I'll give you the other option. What is the number you got after pressing GT? 3 point into 20,000. 75, 800. See, I'll come to calculator tricks in some time. Wait. Let's first understand the concept. If GT button is not there, I'll give you an option. Wait. From the beginning again, 1 divided by, even where GT is not there. Okay, now where GT button is not there, do this. 1 divided by 1.1 equal to M plus, equal to M plus, equal to M plus. You will have to do this 5 times. 1 divided by 1.1 equal to M plus, 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 and plus MRC. 3.790 into 20,000. 3.790 into 20,000. I'll repeat again because I want this calculator trick to be very clear. Otherwise, you'll have to do 1 divided by 1.1 equal to, note down the number, again 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 equal to, and then put a total of the 5. In this process, somewhere you will end up making mistakes. So if calculator can take care of it, great. That's why I said, if that 1 divided by 1.1 itself is not working, please change the calculator. I don't have a choice there. I really don't have a choice there. You will have to change the calculator only. If GT is not working, I have an option. Even in that, it is better if you can get a calculator where GT is available and you do this. This will ensure you save a little bit of a time. It is just the time part which I'm talking about. So I'll repeat again. Listen, I'm repeating again. If you have, listen. If you have a GT button, then 1 divided, listen for a minute and then you start doing it. 1 divided by 1.1 equal to GT. If you don't have a GT button, 1 divided by 1.1 equal to M plus, 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 and then put a MRC. Then put a MRC. Both approaches, you will get a number called 3.790. You will get a number of 3.790. Some up and down rounding of differences can happen. Up and down rounding of some 0.1 here and there, it can happen. But otherwise, you should get what? 3.790 if you put a total. Clear? Any doubts on this? Let's get a present value factor for 10 years now. We'll get it for 10 years. 10 years and 20%. 10 years and 20% in the calculator. 1 divided by 1.2, 20% is 0.2. Equal to 10 times GT or equal to M plus 10 times an MRC. Give me the number. 4.1924. That number, if you get, multiply with the original amount, you will get the final answer. I'll come to formula everything in some time. I'm broadly explaining the purpose of annuity. The purpose of annuity is very simple. If you listen guys, purpose of annuity is very simple. If the amount is same, then I need not prepare a lengthy table like this. That's the only purpose of annuity. If I'm going to do calculation in practical world, I will do a table like this. In Excel, it's not going to take me time. In Excel, it's not going to take me any time, whether it's the same amount or different amount, I am least bothered about it. I am least bothered about it. You tell me to do 50 years calculation also, Excel can take care of it. I have no problem. But when you are doing a problem, if it's an annuity, calculations can become simpler if you understand what is annuity. If you understand what is annuity, calculations can become little simpler. Now, before I even discuss the formula and all, this is called present value annuity. Okay, present value annuity in the calculator, 5% comma 10 years. Give me the factor. 5% comma 10 years. 1 divided by 1.05 equal to 10 times. Please do it. Please do it. 10 years you do it and then tell me the factor. 7.722. Sometimes they may give this factor directly. They may give this factor directly to you. If the factor is not directly given, if the factor is not directly given, then you will have to do calculation like this. Then you will have to do calculations like this. Now write this. How to find, because I think that may not be there in my concept book. Let me check if it's there. It's not there. How to find present value annuity factor. Present value annuity factor. Ideally, whatever I'm doing now, I should not be explaining, because all of this you have done at foundation. I don't know whatever way you have learned it, but this is, everything is done at foundation. It's not something new which I'm trying to explain. It is just to quickly revise what you would have done there. Example, 10% and 7 years. 10% and 7 years. Step 1. 1 divide by 1.1 and press equal. 1 divide by 1.1 and press equal. This is what you will do in the calculator. 1 divide by 1.1 and press a equal. Depending on whether you have the GT button or not, your step 2 will change. Okay, I would prefer if you have a GT. If you don't have, then step 2, keep pressing equal button. Keep pressing equal button. Count number of times. Keep pressing equal button. Count number of times and stop when we have done 7 times. Stop when we have done 7 times. What is 7 times? Is 7 years. Stop when we have done 7 times. Clear? Step 3. Press GT button and get PVAF, present value annuity factor. Press grand total button and get PVAF. In case you want to do it through without GT, same thing, keep pressing equal and M plus. Every stage you'll have to do equal and M plus. One divided by 1.1 equal M plus, equal M plus, equal M plus, equal M plus, equal M plus. This will keep going on. This will keep going on. You'll have to repeat this how many times? 7 times. You'll have to repeat this 7 times. Once you repeat this 7 times, you will get present value annuity factor. You get present value annuity factor. Equal M plus, equal M plus, equal M plus. What we are doing in annuity, let's understand this very clearly. What I'm doing in an annuity is, I have year 0, 1, 2, 3, 4, 5. Every year I'm getting 10,000. So I discount this by 1 year, this by 2 years, this by 3 year, this by 4 years, this by 5 years. So that is what you are doing. So when you do 1 divided by 1.1 equal to first year factor, equal to second year factor, equal to third year, equal to fourth year, equal to fifth year, and you put a total of all the five factors. Put a total of all the five factors with GT. So every year discounting is applied, and then you add them together and multiply with the original amount. Multiply with the original amount. Any doubts on this? Any doubts on this part? Clear? Can you proceed? This is called discounting or finding out the present value. Now comes the compounding part. In compounding, what will happen is, I have to take this to the fifth year, 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 and year 5 number which is there in year 5 itself, which is there in year 5 itself. So if you see the answer, we had original 20 20 20 and we got 122 102 122 102. Now how do I get to this number is what we have to check. In the calculator, I'll do certain steps and then get to that number. So I'll have to get 122 102. One approach is doing the table, which is a time consuming, if it's the same amount. If it's the same amount, why do I do a table? If it's different amount, please do the table. I don't have any choice. In the calculator. Start with 1 m plus 1 and press m plus. No GT will work, I think. 1 and m plus into 1.1 equal to 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 m plus. Now wait, I'll repeat again. We'll do it from the beginning again. What you need to count is the number of times you are pressing m plus. From the beginning. Start from the beginning. 1 m plus 1 m plus into 1.1 equal to 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 m plus and an MRC. Tell me the MRC number. 6.1051 is the total of those 5. 6.1051 is the total of the 5 into 20,000 you do. 122 102, which is the number there. 122 102 is the number there. See, if I want, I can do it in Excel. I have no problem. But in case of yours, you need little bit of a shortcut to get to this factors. One approach is they give you the factor in the question. They give you the factors in the question. But we may get it, we may not get the factors in the question. So how do I calculate the factors? What I'm trying to do. I'll repeat again. You will repeat along with me. Let's take another example. Take another example. 10 years and 15%. 10 years and 15%. I'll give the steps in some time. 10 years and 15%. Now what I want you to do, let's do whatever I'm telling you to do. Very simple thing I want you to do. Right, start 1 m plus. Count the number of times you're pressing m plus. Okay, you're pressed once. Into 1.15 equal to m plus. Into 1.15 equal to m plus. Into 1.15 equal to m plus. Keep counting the number of times you're pressing m plus in your mind. Moment you do 10, stop and tell me MRC. Stop and tell the MRC figure. GT may also work on this, but I'm not very sure, so I don't want to get into the GT part in this. What's the number? Ideally, same number everyone should get. How many years I said? And 15% and 10 years. 20.304. 20.304 is the number you should get I'll repeat again. I'll repeat again. Once you do 2-3 times, you'll get comfort on doing it. I'll repeat again. Do in the calculator. 1 m plus, guys, please listen. 1 m plus, first time you have already pressed, okay, into 1.15 equal to m plus. Second time you have done, into 1.15 equal to m plus. Third time, into 1.15 equal to m plus. Fourth, fifth, sixth, keep doing it. Ten times if you have pressed m plus, please count that. That and all I cannot help it. That control and all you need to have at your end. Do the number of times and then put an MRC. It 100% will work whichever calculator that earlier one was working, okay. So that's why I said that 1 divided by which we did know, if that's not working, you will have to change that brand I had told. That is very, very critical, because any other thing you do will take a lot of time. It's just waste of time otherwise. I'll repeat again. Okay, first you write it. You write the steps. Write the steps. 10 years and 15%. Step 1, press 1 and m plus. In the calculator, 1 then m plus. Step 2, press into 1.15 equal and m plus. Again into 1.15 equal and m plus. Ideally, if the table values is given, I don't need to do all this, but yes, it's good to know, because many questions they don't give the value. They don't give the value. I'll repeat again. Press 1 and m plus into 1.15 equal m plus into 1.15 equal m plus. Step 3, repeat till m plus is pressed 10 times and then MRC. Then MRC. You have to repeat till it is done 10 times. Repeat till it is done 10 times. It's all will come with practice only. So as you do 2-3 times, you will get clarity, but it is all with practice only. Clear? Let's do another example. You will give me the answer and then I'll check and then let you know. 8 years and 14%. 8 years and 14%. I'll repeat first. Listen. What you need to do, listen. 1 m plus into 1 point how much? 14 equal m plus into 1.14 equal m plus into 1.14 equal m plus. How many times you have to repeat this? 8 times and MRC. What's the number you got? 13.233, which is what the table is giving. If you are consistently not getting in the calculator, I cannot help it, because I've explained the steps. If you are not cautious, I cannot do. Otherwise, what I will have to do is, you will have to write 1, then into 1.14 note in your notebook, into 1.14 note in your notebook, into 1.14 note, and then put a total. It will take you more time. It will end up taking you more time. I cannot help it. See, I have told you the steps. If you are still making a mistake, then you are not following what I am telling you. So I have told you what needs to be done. If you follow that, answer will automatically come. If you are adamant saying that I will not follow this, or I will do in a different manner, I cannot help it. Then give me 16% 4 years. 16% 4 years. I told you, no, change, no option. I can't help it. You show me in the break. 16% and 4 years. Please do. Please do. 5 point 5.066. 5.066. Any number of years I can do this calculation. Guys, please. Any number of years I can do this calculation if I want. Any number of years we can repeat this calculation if needed. Clear? Any doubts on this? Any doubts on this? Anybody has a doubt on this? Can we proceed? Clear? Now, guys. Equal receipt or payment for a fixed period of time is called annuity. Equal receipt or payment for a fixed period of time is called annuity. If the cash flow happens at the beginning, it's called annuity immediate, and if it happens at the end, it is called annuity regular. The distinction I have not discussed much as of now. I'll discuss as we proceed. Now, basic thing what we are trying to say is annuity immediate means money will be paid at the beginning. Rent for May month can be paid on May 1. It's called annuity immediate. Rent can also be paid on May 30. It's called annuity regular. It's called annuity regular. Normally, annuity regular will happen. Normally, annuity regular will happen. That is, if the problem is silent, it will be called what? Annuity regular. Whatever example I have told you, all is of annuity regular. What will happen if it's annuity immediate? I'll explain later. I'll explain later. Now, let's take an example. Calculate the amount of deposit to be made today if you want to receive what? 25,500 at the end of each of the next 15 years. At the end of each of the next 15 years. So, my parents came to me, said that, can you tell me what FD should I create today? So that every year we get what? 25,500 first year, second year, third year, fourth year, fifth year. So they want an annuity receipt. They want an annuity for how many years? 15 years. 15 years. Okay, one data is missing here. Rate of interest is missing 10%. It got missed there. Rate of interest is 10%. Rate of interest is 10%. Let's do this now. Basic information. Basic information. Guys, if it's not working in the calculator, don't get panic at this point of time. You'll have to change it. Let's not worry much about it. This I cannot help it, because unless it works in your brand, it will get tougher as we proceed. So you will have to change it. You change it and then see, that is later part of it. Let's not worry as of now. Basic information. Deposit to be made today, in bracket present value, question mark. Deposit to be made today, in bracket present value, question mark. Annuity amount. Annuity amount. What's the annuity amount we are going to have? 25,500. Annuity amount 25,500. Number of years. Annuity type. There are two types. There is a regular and there is a immediate. This is a regular at the end. Immediate I'll explain later. Immediate I'll explain later. Rate of interest I told you to write how much? 10%. In this question they said deposit to be made today. Some other question can say, I will deposit 25,500 at the end of every year for a period of 15 years. What amount will I get after 15 years? What amount will I get after 15 years? Which is called future value of annuity. Which is called future value of annuity. And this is called present value of annuity. You can calculate present value of annuity. You can also calculate future value of annuity depending on what is the need. Depending on the need. Below this, present value of annuity is equal to annuity amount PVAF R, N. Annuity amount present value annuity factor R, N. R, N. What is the annuity amount in my example? Into PVAF, rate of interest. I'll repeat what we do for present value annuity factor so that you get used to it. 1 divided by 1.1 equal to 15 times, or equal to m plus 15 times, and MRC. Give me the factor. Equal to, or whichever way. 1 divided by 1.1 equal to 15 times and GT, or equal to m plus and then MRC. 3 decimal 7.60. Multiply this. Sorry, 1 lakh 93,000. Any doubts on this? What happened? Is there a confusion? Guys, please sort out the confusion if you have. Let me know in case you need any explanation from my side. Unless you tell me, I cannot explain it. Is there a confusion? No. Can we proceed? 193, 953. Listen, same example. I plan to deposit 25,500 at the end of each of the next 15 years. What amount will I have after 15 years? What amount will I have after 15 years? What amount will I have after 15 years? That is, I am planning retirement now. I have been investing this amount. I have been investing this amount for a period of what? 15 years, and I want to know what amount will I get after 15 years. What amount I'll get after 15 years. Now, right, future value of annuity is equal to annuity amount into FVAF R comma N. Be it present value annuity factor or future value annuity factor, we multiply only. Be it present value factor or future value factor, we multiply only. How we calculate present value factors? By doing division, and how we calculate future value factors? By doing multiplication. That's the difference, that's all. But in the end, whatever factor you get, you'll have to only do multiplication. Then 25,500 into FVAF 10% comma 15 in the calculator. I'll repeat. By this time you should get full clarity on it. If you still don't get clarity, I'm okay to repeat it, because till you get this done, I cannot go to the advanced areas. Otherwise, I could have told you learned this at CA foundation and let me proceed with the next set of areas. I could have directly also gone, but this is a base for me where I need full clarity. So in the calculator, 1 m plus into 1.1 equal m plus into 1.1 equal m plus into 1.1 equal m plus. Keep repeating this till you press m plus 15 times, and then an MRC. Then finally an MRC button. What is the factor you got? 31.7772. Let's check whether that is right. What's the number I told? What is the rate? 10%. How many periods? 15. 10%. 15 is 31.772. 31.772. See, If you have made a mindset saying that I'm not getting it, I'm not getting it, I cannot help it. I have told you the step. If you are not ready to follow what I'm telling you, then obviously the calculator will not give you this number. If you are following, you will 100% get it. Some brands it does not work. I've already told you where I don't have a choice. You will have to change it only. Just check which brand both are working and please get that calculator only so that at least it is taken care of. Again, I'm repeating, don't tell me that I'll somehow manage it. No managing it. If something it could be managed, I would have told you it's okay, you use your calculator. I'm telling you the first class itself, I want a change in calculator. Next session onwards, there should be a different calculator if it's not working for you. If it's not working for you, please change the calculator. Clear? Any doubts on this? What's the amount you get? 8 lakh 198. Any doubts on this? I'll summarize what I have done till now. I have to explain annuity immediate because I explained this and we do some questions and then come back. So first thing we learned is time has a value attached to it. Time has a value attached to it. Sorry, money has a value attached with the time. As time increases, value of money keeps going down because of what? Because of inflation. Because of inflation, the value of money keeps going down. The value of money keeps going down. In order to arrest this, I have to invest money. I have to invest money where we have a concept called compounding. Future value is equal to present value into what? 1 plus r the whole power n or into future value factor. Into future value factor. If you want to come to today's value, present value is equal to future value divided by 1 plus r the whole power n, or you can multiply technically with future value factor or present value, whichever you want to calculate. Whichever you want to calculate. Same goes for annuity. Same goes for annuity. Multiply with future value annuity factor or present value annuity factor. This is for annuity regular. Immediate I'll explain in some time. Immediate I'll explain in some time. Clear? Any doubts till this? Anybody has any doubts on this? Okay. The first example is already done. That was the example I did. Second example, question bank. Please open question bank 170. 170. Question bank page 170. Question 2. Your coin collection contains coin worth 50,000. If they were bought in face value in 2010, what will be the value in 2035? Assuming they appreciate at 4% per annum. This is the question. Okay. Let's start writing it. Okay. Let's start writing it. Basic information. Basic information. Basic information. Present value. Present value. What are the two time periods question is talking about? 2010 and 2035. Listen. Again, let's be very clear. Assuming I'm doing a question where they give 2010 and 2024. 2010 is the prior period and 2024 is the later period. This is called present value. This is called future value. We are in 2024 today, but still 2024 will be called future value for these two data. Another question, 2024, 2054. This is called present value. This is called future value. 2030, 2025. 30 is called future, 25 is called present. Whichever is the earlier period is called present value. Whichever is the later period is called future value. So today you're doing 2010 to 2035, then they're saying repeat from 2035 to 2045. 35 will become present value, 45 will become future value. From which date you are going to which date? Earlier date is called present value, later date is called future value. Earlier date is present value and later date is future value. Clear? Any doubts on this? Any doubts on this? Be very clear on the concept. So in this question, this 50,000 is when? 2010. 50,000 is 2010 and they're asking what will be the worth in which year? 2035. 2035. Now write present value in bracket 2010. How much? Future value in bracket question mark. Present value 50,000. Future value question mark. Rate of interest. Time period. Future value is equal to present value into 1 plus r whole power n into 1 plus r whole power n. It is always with practice clarity will come. What is needed is only practice. What is the present value? Rate of interest 0.4. Power how many years? How will you get this? 1.04 into 1.04, that is the square, into 1.04, 3 into 1.04, 4 into 1.04. It's a time consuming process but can't help it. Do in the calculator. 1.04 into 1.04. Moment you press equal to, you have got square, into 1.04 equal to cube, into 1.04 equal to 4, into 1.04 into 1.04. Keep repeating it. Some calculators it will work, some it may not work. Keep doing it. Power 25, I need the number. Power 25, I need the number. 2.3 decimal, 2.666, 2.666, 1 lakh. Any doubts on this? Clear? Any doubts on this? Again, I'm repeating just because it's 10 years, 15 years. If you keep in mind that how many years, why I'm doing, I cannot help it. I have told you the approach. If you follow the approach, you will get to the answer. If you follow the approach, you will get to the answer. Clear? Any doubts on this? Okay. At this stage, let's take a break of 45 minutes and then we resume. We resume at 1:45. We'll resume back at 1:45. Okay, let's continue now. In the earlier session, we had, guys, please. In the earlier session, we started with time value of money discussion, where, guys, please, where we learned that the worth of the money will keep going down with passing of time. This is because of inflationary condition. Because of inflation, the value of the money will keep going down. If somebody wants to preserve the value of the money, he has to make investments, where two concepts came into picture: future value and present value. Present value is today's value, future value is tomorrow's value of today's money. Tomorrow's value of today's money. In order to calculate future value, we multiply with 1 plus r the whole power n. And in order to calculate present value, we divide by 1 plus r the whole power n. Multiplying is called compounding and dividing is called discounting. These two can otherwise be called as future value factor or present value factor, which you directly multiply. Then I had started with annuity. Annuity means equal payment or receipt for a specified period of time. For a specified period of time, that's called annuity. Annuity regular means it happens at the end of the year. Annuity immediate means it's happening now. It's happening now. Open the concept book. Open the concept book. Open the concept book. Okay, now listen. This I explained in the previous session where we multiply with the factor. How you calculate present value annuity factor is 1 divided by 1 plus whatever the rate equal to m plus or equal to GT. For future value annuity factor, 1 m plus into 1 point whatever number equal m plus into equal m plus. This cycle will have to keep going on till you press the m plus required number of times. If it's immediate, means every data is getting preceded by 1 year. Every data is getting preceded by 1 year, whose value will be better. Whose value will be better. See, I give you two choices saying that I will pay you 1 lakh at the end of every year or 1 lakh at the beginning of every year. You'll obviously say give me at the beginning itself because that is obviously better. So just make one small change here. Whatever your answer you get here into 1 plus r, even in this also, just write into 1 plus r. In the present value also write into 1 plus r. Whatever earlier answer you get into 1 plus r is the immediate answer. Logic for 1 plus r will explain. Write into 1 plus r. Same formula. Annuity amount into future value annuity factor you do or present value annuity factor you do, you get the normal answer. If you want immediate, do into 1 plus r. Why this 1 plus r? I'll explain. Why this 1 plus r for both formulae? For both formulae, write 1 plus r. Be it present value, be it future value. Both the places correct it. Be it present value or future value, it's into 1 plus r. Now let me explain logic of 1 plus r. 1 plus r, guys, no disturbance please. 1 plus r basically means you earn return for one more year. 1 plus r, today I want to know what is 1 year end value into 1 plus r power 1, which is into 1 plus r, which is into, so you get extra return for 1 year. You get extra return for 1 year in case of what? Immediate. In case of immediate. So whichever problem, if they give immediate annuity, first do it in the normal manner and then do into what? 1 plus r, be it present value, be it future value. I had another approach that also will give the same answer only, but this is a better approach, makes it easier for me to do. You will do into what? 1 plus r, into 1 plus r. Clear? Any doubts on this? Any doubts on this? Clear? Okay, let's come to question. We are done till question 2, no? Let's do question 3. Calculate the amount which Mr. Shyam should deposit now to receive 50,000 after 15 years. Interest rate is 9%. Let's capture the basic information. Let's capture the basic information. Now first read this and tell me, are we required, this 50,000, is it present value or future value? 50,000 is future value and we are required to find today's value. We are required to find today's value. Basic information. Basic information. present value question mark, present values question mark, future value, how much the future value? Rupees 50,000, rate of interest 9%, time period 15 years, present value is equal to future value into PVF. I'll be writing now onwards only present value factor, future value factor, present value annuity factor, future value annuity factor. That's the term I'll keep using now onwards. No writing into 1 plus R or divided by 1 plus R. Basically, it's the same thing, but writing will be in this way now onwards. Future value into PVF R comma N. What's the future value given? 50,000 into present value factor. R is how much? 9% comma 15 years. In the calculator, 1 divided by 1.09, 1 divided by 1.09 equal to first year, second, third, fourth, fifth, sixth, seventh, 8, 9, 10, 12, 13, 14, 15. What's the number you get? 0.275. 0.275. 13,750. Any doubts on this? Clear? Can we proceed? A fairly simple, straightforward calculation just to explain the concept. Purpose is to understand the concept clearly. Any doubts on this? Can you proceed? Fourth one we have done already. That is that other example. Let's come to this. Find the amount of an annuity if payment of 500 is made annually for 7 years at interest rate of 14% compounded annually. Now, first thing, let's understand, are we required to calculate future value of annuity or present value of annuity? Let's have clarity on that. Is it future value of annuity asked or present value asked? What is your sense? Why future value? 7 years can be even present value also, no? One is there is a word used compounded, which means I will be taking it to a futuristic period. Amount technically would mean the maturity amount. Amount technically would mean the maturity amount. Same question can say find the deposit to be made today. Deposit to be made today if 500 is to be received every year for a period of 7 years. If 500 is to be received, and for that I want to create a deposit today. I want to create a deposit today. Now write basic information. Future value of annuity question mark. Future value of annuity question mark. Of annuity question mark. Annuity amount. Annuity amount. Time period. What's the time period? 7 years. Rate of interest 14%. Annuity type. Anything mentioned beginning, end? Nothing is mentioned, then it's regular. If nothing is mentioned, it is regular. Annuity type regular. If problem is silent, we take it as regular. Future value of annuity is equal to annuity amount into FVAF, future value annuity factor R comma N. FVAF, future value annuity factor in bracket R comma N. Future value annuity factor R comma N. What is the annuity amount here? into future value annuity factor. What's the rate of interest? How many time periods? 7. In the calculator, I'll repeat again. This is the last time I'm repeating this. You start with 1 m plus into 1.14 equal to m plus into 1.14 equal to m plus. The cycle you will have to repeat till you press m plus 7 times. Till you press m plus 7 times. 500 into what? 730. Okay, 10.730. 5365. 5365. Any doubts on this? Okay, same question I'm repeating. Same question I'm repeating, right? Rework. If annuity is immediate. Rework if annuity is immediate. Rework if annuity is immediate. Same formula into 1 plus R. Into 1 plus R. Whatever we did some time back, just do into 1 plus R. 500 into 10.730 into what? 1 plus how much? 0.14. 6116. 6116. Any doubts on this? Immediate means you get 1 more year of valuation. 1 more year of valuation. Rework if present value of annuity regular is needed. Present value of annuity regular. Rework if PV of annuity regular is needed. Annuity regular is needed. Present value of annuity regular is needed. Now write present value of annuity is equal to regular. Okay, I'm repeating it is regular. I'll give another rework which is annuity immediate. First we did future value of annuity regular, then future value of annuity immediate. Now present value of annuity regular and then present value of annuity immediate. Annuity amount into PVAF R comma N. PVAF R comma N. What is the rate of interest? Comma 7. 14% comma 7. Now what you need to do in the calculator is 1 divided by 1.14 equal to 7 times GT or equal to M plus and an MRC, whichever way it works for you. 1 divided by 1.14 I have used GT function. What's the number you get? 4.288. Whichever way it works for you, 4.288. 21. Any doubts on this? Any doubts on this? Okay, I want you to get me an answer. Okay, this is just to get full clarity on the concept. This 2144 you calculated, no? Into 1.14 power 7. I want this answer into 1.14 power 7. That is, multiply this with 1.147 times and get me the number. Which is this number? 5365. Basically, these cash flow we got today's value. If I want to go to 7th year value from whatever you got now, you can do into 1.14 power 7 or whatever you got here. You can divide this by 1.14 power 7. You will get the present value of annuity. These are a lot of interlinkages which I want to be very clear to you. You can keep moving the way you want. You can move from day 0 to day 365, or year 1 to year 2, year 2 to year 1, year 5 to year 10. Any way you can move it. This is just another way of just cross verifying the answer, being very clear on the concept. Any doubts on this? Next, rework PV of annuity immediate. PV of annuity immediate, same formula into 1 plus R, into 1 plus R. In the material I've mentioned it in a slightly different manner, but this is easy to do. Just do into 1 plus R, into 1 plus R. Was the answer? Triple. Any doubts on this? Anybody has any doubts on this? Clear? Can we proceed? Any doubts on this? Okay. Question 6. I'll give you 5-6 minutes. Start doing, get me all the 4 answer. Annuity regular, annuity immediate, present value, future value. Everything I want you to do. 5-6 minutes for you to do. Start doing it. Okay, let's discuss the answer. First is future value of annuity regular. What's the annuity amount? 25,000 into FVAF. What is the rate of interest? Number of years? 15 years. So 25,500 into, what is that factor? 7? 7.2. I'm not getting into the number. This is the first calculation. Then future value of annuity immediate is equal to whatever you got up into 31.772 into 1 plus R. 1 plus R, which is 10%. Any doubts on this? Then present value of annuity regular, that is the deposit to be created today. Something is asked in the question, which is 25,500 into PVAF 10%, comma 15. What is the present value factor? 7.606. Present value of annuity immediate. My presentation in the printed material could be slightly different, but the answer will match. Into 1 plus 10%. Into 1 plus 10%. Clear? This is how we'll do the 4 category of questions. Regular, immediate, future value factor calculation is 1 m plus into 1.1 equal to m plus into 1.1 equal to m plus. Cycle will keep going on for 15 times and I get an MRC. 1 divided by 1.1 equal to or equal to m plus, whichever way it works. Any doubts on this? Clear? Can we proceed? Now annuity immediate, I've presented it slightly different here. Doesn't matter. You would have got this answer. Did you get this 213, 359? You would have got the same answer. Presentation is slightly different. Let's not worry much about it. Clear? Now, what is the purpose of this annuity? Let's understand. There are multiple purposes of annuity. Let's take one simple example. I am planning to have, my requirement is 1 crore in 20 years. This could be a requirement of a person. He wants to have 1 crore in 20 years and he wants to know what amount should he deposit every year. Every year, we can do every month also, but every year is the requirement. So 1 crore, future value is 1 crore, is equal to annuity amount into FVAF 12%, comma 20. This annuity amount will be the balancing figure, which you can tell to the other person that please invest 20 lakh, 30 lakh, 40 lakh, 5 lakh, 2 lakh, whatever the number it turns out to be. Whatever the number it turns out to be, because I wanted 1 crore after 20 years. So this is one purpose of this annuity analysis. This is one purpose of the annuity analysis. Let's see this in this example. ABC has issued debentures of how much? 50 lakh to be repaid after 7 years, which means I need 50 lakhs after 7 years. I need 50 lakhs after 7 years. How much should I invest in sinking fund earning 12% in order to be able to repay the debentures? In order to be able to repay the debentures. Now, right. Future value needed. Future value needed. How much money do we need? 50 lakhs. See, I can come to you and say that I am planning to retire after 10 years and I need 2 crore 50 lakh rupees. Can you please tell me what should I invest? So that's a practical application of this concept. 50 lakh, number of years, 7 years, annuity type, regular, annuity type is regular, rate of interest, how much? 12%. Annuity amount in bracket sinking fund investment. Sinking fund investment is question mark. How much should I invest every year? How much should I invest every year is my question mark, which I'm trying to find. That's the question mark we are trying to tackle. Sinking fund investment. Right below this, future value of annuity is equal to annuity amount into what? Into FVAF in bracket 12% comma 7. This is an annuity regular. If it's an annuity immediate, add into 1 plus R there. Add into 1 plus R. Get me the annuity factor. %, comma 7. 1 M plus into 1.12 equal to M plus. What's the number? 10 point? Sorry? 10.18. So 179 is 180. Okay. Are you getting this number? Whatever works. Whatever. Sorry? 0? Okay, 10.089. See, whichever way it works in your calculator. If GT works, use GT. If MRC works, use MRC. Whichever works in your calculator, keep doing that. Annuity amount. 50 lakh divided by 10.089. 4 lakh 95,589. Any doubts on this? This is one application of this concept. Can we proceed? Any doubts on this? Now, another application. A has taken a 20-month car loan of rupees 6 lakh. Rate of interest is 12% per annum. What will be the monthly loan amortization? What will be the monthly loan amortization? What do you mean by monthly loan amortization? What is the technical name? Yes, it's annuity. What is the technical name? EMI, equated monthly installment. EMI is what we are required to calculate. Many a times practical world, interest or loan will be repaid every month rather than once a year. It will be every month. So EMI is what we are required to calculate. Let's capture basic information. Question 8. How much is the loan taken? 6 lakh, that is today's value. 6 lakh is today's value of the loan. If you don't repay, 6 lakh will become 7, 8, 9 with interest. So 6 lakh is today's value, right? Present value of annuity. present value of annuity in bracket loan taken. Now, once you solve this question, practical world, somebody can ask you saying that I have a home loan. Today I am paying this much EMI. Interest rate will change. What will be the revised EMI? So you can calculate your EMI using this formula saying that, okay, you tell me the interest rate, I'll substitute that interest rate and tell you the answer. This is the purpose of this concept. In the end, somehow you'll have to use this in a practical world. If otherwise, there's no point in learning this. So in case there is a change happening on the interest rate, what will be the impact on my equated monthly installment? Next, time period 20 months. Rate of interest. Now listen, 12% doesn't really help me because I have to pay every month. Means you have to tell me month per month what is the interest. So 12% is right, but we'll say 12% per annum or 12% per annum or how many months? For how much per month? 1% per month. 1% per month. If you are doing monthly calculation, do per month. If you're doing quarterly calculation, do per quarter. If you're doing half yearly calculation, do per half year. Whichever way you do, that doesn't really matter. Whatever you are doing, for that you will have to do the respective calculation. Next, annuity amount in bracket EMI is question mark. Annuity amount is basically the EMI. Present value of annuity is equal to annuity amount into PVAF R comma N. Annuity amount into PVAF R comma N. R comma N. 6 lakh equal to annuity amount is what we are calculating into annuity amount into PVAF. What is the R? It's not 12%, it is 1%. 1%. And N is what? 20 months. Let's assume question says 5 years. Then you will write N as 60. You will have to write N as 60. 5 years means 60 months. 5 years means 60 months. If you are doing monthly calculation, N has to be for months, R has to be for months. Consistency is very critical. Consistency has to be there in the solution. Tell me the annuity factor. 1%, 1 divided by 1.01 equal to M plus or equal to GT for 20. How much? 04? Okay, 046. 18.046. 18.046, and this will give me my annuity amount. This will give the annuity amount which I'm looking at. I wanted the annuity amount and the format will give me that answer. Any doubts on this? What's the annuity amount? 33,000 to 48. Any doubts on this? Now let's understand the practical application of this. Now the question says interest rates have been increased from 12 to 13.2%. Just imagine it is 13.2%. What is the increase in EMI? Because practical world, this is the application. 13.2 means 1.1%. 1.1%. 1 divided by 1.011. 1.1% is 011. Tell me 20 month annuity factor. 1 divided by 1.011. 1 divided by 1.011. whatever number you have, do 6 lakh divided by that number which you got. 6 lakh divided by that number which you got. 33,000. So my EMI is going up by approximately around 300 rupees because of this change in interest rate. This is the practical application, because whenever interest rates change, EMI amount will change. EMI amount will change. This was a small loan, which is only a 20-month loan. Practical loans are taken for 20 years. So when you take such a longer loan, even a small change will have a significant impact on the EMI amount. Will have a significant impact. Any doubts on this? Clear? Can we proceed? Okay, I'll move to the next concept, which is on an area called perpetuity. Now, I want your participation. Let's understand that ICICI Bank or State Bank of India, which is a credible bank, no problem with their liquidity or the future prospects. They say, give us 10 lakh today. Give us 10 lakh today. We will pay you 50,000 for infinite number of years. We'll pay you 50,000 for infinite. Infinite means you get it, your next generation gets it, next to next generation gets it. There is no end to it. No end is called perpetuity. No end is called perpetuity. I do not put an end to this. I do not put an end to this. I am saying that I will give you this amount for infinite number of years. For infinite number of years. Would you agree to this? 10 lakh rupees give, get 50,000 for infinite number of years. Yes, no, with the logic, whatever it is. You have been given this choice now. You decide and let me know. I want participation, guys. Give 10 lakh, get 50,000 every year. Yes, no, with reason. I don't want just the answer. Whatever is your logic for it. So, I don't want any technical answer. So, when you say depends on interest rate, what do you mean then? You have come to the point which I wanted, but what do you mean by depends on interest rate then? I'm not giving you any interest. I've told you very clearly 50,000 for infinite number of years. I will pay you 50,000 every year. You guys are going in the right direction, but you'll have to make it sharper and then tell me what it is. Okay, ठीक So your basic logic is 50,000 worth will keep going down, and you wanted to compare it with the present value. ठीक What else? That's one logic. Any other answer? I need participation, guys. Right, wrong doesn't really matter. Some of you have participated, some of you have got it right, some of you have got it wrong. That's okay. No, you are in the wrong direction. Not 20 years. First of all, if you give me 10 lakh and I pay you 50,000 every year, you don't recover your money in 20 years, because 50,000 every year cannot be compared with today's 10 lakh. Cannot be compared. Only answer I want is, someone had already asked you, what is interest rate today? If let's assume interest rate is 7%. If it is 7% today, I will create a FD with the same bank, get 70,000 every year, and my principal still remains intact. My principal still remains intact. 10 lakh into 7% is what? 70,000. My principal I'm not even touching. My principal I'm not even touching. Next year again same 10 lakh, 7%. 10 lakh, 7%. 10 lakh, 7%. So I can keep getting 70,000 as a perpetuity. Why should I restrict myself to 50,000? So there is a formula to value a perpetuity. What is the formula to value a perpetuity? I said you will get how much? 50,000. This is called perpetuity amount. This is called perpetuity amount. And I'm going to divide this with, let's assume market rate of interest is 4%. Let's assume it's 4%. Once you divide, what do you get? If SBI is asking anything lesser than 12 lakh 50, go ahead and give them money. It is worth 12 lakh 50. That perpetuity is worth what? 12 lakh 50,000. Perpetuity is worth how much? 12 lakh 50,000. How is it worth 12 lakh 50? Because every year you are going to get 50,000 rupees. I can show you this calculation also. Let's assume year cash flow PVF DCF. There is no end to this. Every year you are getting 50,000. Your annuity factor is 4%. Annuity factor is 4%. So 1 divided by 1.04. First year, second year, third year, fourth year, it keeps going on like this. It will keep going on like this. And its present value today is 50,000 into this. This is the calculation I've done for 4 years. Okay, I've done this for 4 years. First year 50,000, its present value. Second year 50,000, its present value. Like this. Just give me. This is the calculation for around 600 years, and the value is almost zero now. The value is almost zero. And if I put a present value total of this, if I put a total of this, I get 12 lakh 50. I get 12 lakh 50. This is infinite calculation. In Excel, I can do infinite calculation. If it's for limited number of years, you do discounting of every year cash flow and get today's value. If it's an annuity, you use annuity factor. If it's different amounts, you use different factors and get today's value. Perpetuity doesn't have an end. Perpetuity doesn't have an end. So valuation of perpetuity formula is perpetuity amount divided by what is the interest rate. Divided by what is the interest rate. This is one calculation. Okay. Now the bank said I'll give you 50,000 every year. I said 50,000 first year is okay, but second year giving me 50,000 doesn't help because inflation is there. Because of inflation is there, you don't give me the same amount every year. You don't give me the same amount every year. Now what happens is, let's assume interest rate in the economy is 10%. Let's assume interest rate in the economy is 10%. I'm changing the number. Now the value of perpetuity is 50,000 divided by 10%. 50,000 divided by 10%, which is how much? 5 lakh. 50,000 divided by 10% is 5 lakh. If I put a total for 600 years, I get 5 lakh total here. I get 5 lakh total here. Now I argued about it, and then he said, okay, I'll give you 50,000 for the first year. Second year, this will increase by 4%. I can increase this by 4%. Third year, another 4% increase. Fourth year, another 4% increase. I'll keep increasing this by 4% every year. 4% every year. The formula for this is perpetuity amount, which in my example is 50,000. Rate of interest 10% minus the growth rate. Why growth is subtracted, you will understand when I do it in the Excel. When I do it in the Excel, 10% minus 4%. What's the answer you get? 8,33,333. So listen here, 50,000 next year into 1.04, 52. I keep increasing this. Okay. So I keep increasing this. It at some stage it will reach okay, the total is here 8,33,333. In Excel, I can do calculation for any number of years. I can do calculation for any number of years. So when I do this calculation, I ultimately get a value of what? 8,33,333. The logic is very simple. Now, see, earlier the deposit was giving you 10%, and the entire money I gave you back. The entire money, whatever I was earning as interest, I was giving it to you. Now what happens is, because you want this to grow, whatever I earn, no, part of it I will increase it to my principal so that I can earn you more in future. See, what is growing perpetuities? Today you wanted 50,000. Today I can give you 50,000 if deposit is 5 lakh. Next year, if you want more than 50,000, obviously I want a higher deposit. I want a higher deposit. That's called growing perpetuity. That is called growing perpetuity. So for a growing perpetuity, formula says perpetuity amount divided by rate of interest minus growth rate. Even for the normal perpetuity, it's minus growth only. Growth is zero. Growth is zero. It's a single formula only. Rate of interest minus growth rate. Rate of interest minus growth rate. Why growth is getting subtracted? Because you have to retain that money in the business. So earlier you were creating 5 lakh deposit. That was sufficient. Now you have to create a higher deposit. Now you have to create a higher deposit. When you create a higher deposit, I can then only keep growing it. I can then only keep growing it. How will I grow this now? Listen, 8,33,333. I will earn 10% on this. 83,333 I'm earning 83,333. In this I will give you 50,000. In this I'll give you 50,000, retaining how much extra? 33,333. See, amount you give me is 8,33,333. I earn 10% on this, 83,333. You wanted how much? 50,000 rupees, which I'm giving it to you. Next year, this plus this minus this. This is my principal value. On this, I will earn now 86,666. I'll give you 52,000 now, extra 4%. Next year, what will happen? This plus this minus 52,000 minus 52,000. Next year, I earn this. In this, I'll pay you 52,000 plus again 4%. Next year, this will go, this will go up. 83,333 plus 4% is how much? In the calculator, do 83,333 plus 4%. Plus 4%. So what growing perpetuity basically means is, you give me a value, I will earn 10% on that, give you a part of the amount, retain the balance. Next year I earn more, give you more. Next to next year I earn more and more, I'll give you more and more. This is the cycle which will keep repeating. That is called growing perpetuity. Here, every year I will earn 4% more and more, and I'll keep paying you 4% more and more. That is the cycle which will keep going on. That is called growing perpetuity. Growing perpetuity logic is very simple. Without growing perpetuity, it doesn't make any sense. See, assume I had created a perpetuity 20 years back. I was happy with getting 10,000 per month. Now 10,000 per month cannot help me in any way, because my expenses are very high at this point of time. So that is why we have a concept called growing perpetuity. We have a concept called growing perpetuity. How we value perpetuity? Whatever perpetuity amount you have, divided by rate of interest minus the growth. Why minus growth is added in the numerator, sorry, in the denominator? So that I collect more money from you. When I collect more money, I earn more, but I pay you only 50,000. Balance, what I do? I add it to my principal. I earn more, I give you more, retention is there. So the cycle will keep going on. Next year, what will happen? You will give 52,000 into 1.04 was there, and this money, this cycle will keep going on. I'll keep earning 444 extra, keep giving you 444 extra. This is called growing perpetuity. Growing perpetuity. Objective is very simple of growing perpetuity, because at some stage giving me 50,000 doesn't make any sense. Giving 50,000 after 10 years, 15 years, the value is almost negligible. Almost negligible. So I need a perpetuity which can keep growing, which can keep growing. Any doubts on this? Any doubts on this? So let's see this example. Assuming that the discount rate is what? 7% per annum. How much would you pay to receive 50 growing at what? 5% annually, growing at 5% annually. Perpetuity amount is 50 divided by 7 minus 5. What is discount rate? Is rate of interest. 7 minus 5, 2,500 will give me 50. Keep growing at the rate of 5%. Keep growing at the rate of 5%. Why are we growing? Because 50 rupees today is sufficient. Later on it will become insufficient. Later on it will become insufficient because of inflationary condition. All that is known fact. Because of inflationary condition, this value will start becoming lesser utility. That is why I want to earn more. Any doubts on this? Any doubts on this? Let's see an example again. Question 9. Ramesh wants to retire and receive 36,000 a year. He wants to pass this yearly payment to future generations after his death. He can earn an interest of 8%. An interest of 8%. How much will he need to set aside to achieve his perpetuity goal? To set aside his perpetuity goal. Listen. Till now, whatever I did, I told you present value of annuity, future value of annuity. Present value of single cash flow, future value of single cash flow. Present value of different cash flow, future. there can only be present value of perpetuity. There cannot be future value because perpetuity has no end. Perpetuity has no end. So I cannot calculate what? Future value of perpetuity. I can calculate only what? Present value of perpetuity. So if you read the question, it says how much you need to set aside. That is, how much should I keep today so that I get what? 36,000 a year, and this goes on to my future generation also. This goes on to my future generation. Now, right, present value of perpetuity is equal to perpetuity amount divided by rate of interest minus growth rate. Rate of interest minus growth rate. Rate of interest minus growth rate. What is the perpetuity amount? Rate of interest. Any growth? Give 4 lakh 50, earn 8%, 36,000. Again 4 lakh 50, 8%, 36,000. It's a cycle which will keep going on. It's a cycle which will keep going on. Any doubts on this? The only problem is if interest rates change, then we get into trouble. But that's a risk you have to face. Any doubts on this? Yep. Okay, this example I've already done. 50 rupees, 7 minus 5%. 7 minus 5%. Perpetuity is a very important concept when I'm going to do my capital budgeting calculation or when I do cost of capital chapter. It's an extremely important area of discussion. Any doubts on this? Any doubts on this? Last concept, I have something called as effective rate of interest. Okay, let's understand what is this effective rate of interest with an example. You go to a bank and ask them, tell me the rate of interest. Bank tells Bank A 12% per annum interest payable every month. Interest payable every month. This is what Bank A is telling. Bank A is saying 12% per annum and interest will be paid what? Every month. Bank B 12.5% per annum interest payable at end of year. Interest payable at end of year. One bank is saying 12% per month and interest is payable what? Every month. Another bank is saying 12.5% per annum and interest is payable at end of year. Which is better, 12 or 12.5? How 12? So it's per interest is 12% per annum. I'm going to pay every month. Every month when I pay, I'll pay only 1%. No, not 12% per month. It's 12%. No, 12% per month. It's 12% per annum. Which is better? I have given you two choices, 12, 12.5 with certain points mentioned there. Whatever comes to your mind, you tell me. 12 point? Is 12 better or 12.5 better? Both cannot be compared. Point number one. I cannot compare these two. One is apple, other one is orange. You cannot do this comparison. Now, what is the problem? The problem is this. Let's assume month FD, interest, closing FD. In bank B, I created 1 lakh FD. It became 1,12,500. It became 1,12,500. I created what? 1 lakh FD. It became 1,12,500. In this bank, first month 1 lakh FD I created. He paid me 1%. I said I don't need this money. Okay. I said I don't need this money. So it will become 1 lakh 1,000. It will become 1 lakh 1,000. Second, on 1 lakh 1,000, he paid me 1,010. He paid me 1,010. It became 1 lakh 2,010. It became 1 lakh 2,000. 1% only is paying. 1% is only paying. This goes on for 12 months. On the maturity, I'm getting 1 lakh 12,682. Whereas there I was getting 1 lakh 12,500. Here I'm getting 1 lakh 12,682. There I was getting 1 lakh 12,500. 500. One is 12%. Another one is 12.5%. One is 12%. This is 12%. This is 12%. I have not done any error or anything different here. This is the calculation. I am ending at 1,12,683. Another person, he said, why are you creating 12% FD? Let's create 12.5. He did that. His 1 lakh has become 1,12,500. Obviously, this is better. 112,683 is better than 112,500. So, whenever interest is paid at a periodicity of less than a year, two interest rates can never be compared. You can never compare two interest rates. For example, this is the interest paid by a bank, and for example they are saying 1 year will pay 8.2. Next to it they have said 8.46. Next to it they have said 8.46. I'll be paying 8.2, but you will be getting 8.46. How is it happening is what I'm going to explain now. How is this happening is what I'm going to explain. For example, here I paid 12%. How much interest we have earned? Minus 1 lakh. Our interest earning is, if I add 12 months interest, I earned 12,683, which is effectively 12.68%, which is effectively 12.68%. But what did I pay? 12%. I paid only 12%, but you earned how much? 12.68%. The bank is saying interest rate annualized yield, I will give you 12, but you will get 12.68. I'll give you 10, you will get more than 10. How is that happening is what is the next concept, is the next concept. Now how do I calculate this is, listen. Effective rate of interest is equal to 1 plus r the whole power n minus 1. 1 plus r the whole power n minus 1, which is 1 plus. In this example, when are we paying interest? Every month. So 12% per annum is wrong. It's 1% per month. So 1 plus 1% power 12 months in a year. Power 12 months in a year minus 1. Get me this number and minus 1 and tell me the answer. 1 plus 1% power 12. Power 12 you do. 1 plus 1% power 12 is how much? 1 point minus 1. 0.1268 or 12.68%. 12.68%. So obviously 12.68 is better. Now only you can do comparison. You cannot do comparison of 12 and 12.5. If it was 12% per annum payable monthly, 12.5% per annum payable monthly, both are monthly, do comparison. I have no problem. Do comparison. If one is having a compounding frequency of every month, another one is every quarter, or one is half year, another one is every year, we'll have to convert everything into yearly rate, which is 1 plus r the whole power n minus 1. Now practical application, it says 8 point, or it says 8% here, it says 8% here, and next to it says 8.24%. next to it they are saying 8.24%. now it could be various reasons, I don't know the reason. I have no idea what is the compounding frequency they are applying here. Let's assume, let's take another, write this example, 8% per annum payable quarterly. 8% per annum payable quarterly. Per annum payable quarterly. Effective rate of interest is equal to 1 plus r whole power n minus 1. 1 plus r whole power n minus 1. Tell me what is the interest for a quarter. If it's 8% per annum, what is the interest for one quarter? How much? 2%. How many quarters in a year? Power 4 minus 1. Do this and tell me. Which is what is given in that table there. I had shown you the website of Equitas Bank, 8%, and in the side they have mentioned 8.24% because they are paying quarterly interest. They are paying quarterly interest. So 8% in the side they have mentioned what? 8.24%. This gives to one more angle. The angle is whenever you take a loan from a bank, you pay monthly interest. If you are paying monthly interest, if interest rate is 9, you'll be effectively paying 9.5 or 9.6 or 9.7. You'll be paying more than the rate quoted to you. And when you create a FD, if they pay you 8 and they pay every month, see, you see this advertisement here. This is an advertisement of the bank. 8, and the side they've said what? 8.24. Reason to tell you is that we are giving you 8.24 effectively, create FD. But whenever you look at a loan, they will never mention the effective rate there because the effective rate will be normally higher than the normal rate. Whenever the frequency is what? More than a year. Whenever the, sorry, less than a year. Whenever the frequency, if you pay every half year or every quarter, you will obviously see a higher rate. You will obviously see a higher rate. This concept is called effective rate of interest. This concept. So suddenly a question says, I give you two choices: 6% per annum payable monthly, 6.5% per annum payable half yearly. Now you cannot tell which is better without doing what? Effective rate of interest. Without doing effective rate of interest. Don't just look at 6 and 6.5. All these are mistakes which we normally make. Don't look at 6 and 6.5 and say 6 is better or 6.5 is better. No, I will have to look at what? The effective rate of interest. Clear? Any doubts on this? Any doubts on the concept? Now let's come to this example. Interest is 10% payable quarterly. Please calculate me effective rate of interest. 1 plus r the whole power n minus 1. Quarterly interest. Apply 1 plus r the whole power n. What will be r you take here? 1 plus r whole power n minus 1. 1 plus what? 2.5% power what? Minus 1. 1.25, 2.5% is 0.025. 1.025 power 4 is how much? Guys, participate please. 1 point minus 1. So if some bank is paying you 10% quarterly, you will earn 10.38%. You will earn 10.38%. See, whenever you create an FD, always tell, whether you, at your home, if your parents are creating a fixed deposit, ask them when the interest will be paid. If interest is paid every month, it's monthly compounding. Every quarter, quarterly compounding. Every half year, half yearly compounding. Every year, yearly compounding. All of this is practical application. Extensive practical application is there. Let's look at the next one. Compound value and compound interest. Compound value and compound interest of an amount of what? 75,000 at what? 8% compounded semi-annually for how many years? 5 years. It's basically calculating future value. Compounding means calculating future value. But when you do that, you will have to be little cautious. You will have to be little cautious. Let's write this question 12. Let's write question 12. Let's write question 12. Future value is equal to present value into future value factor r comma n. R comma n. R comma n. 75,000 into 75,000 into, what is the compounding frequency? Semi-annually means you will have to tell me rate of interest per half year and number of half years. Rate of interest per half year and number of half years. Number of half years. You cannot take it as 8%. You will have to take it as what? 4%. You will have to take it as 4%, and it's not 5 years. It is 10 half years. 10 half years. Whenever the compound, if it's quarterly, 2% and 20 quarters. 2% and 20 quarters. And if it's monthly, 0.67% and 60 months. So this is future value factor 4%, comma 10. Get me the future value factor for 1 divided by 1.0. Sorry, 1 into 1.04. No. 1 point, sorry. 4802. Okay, 480. 3 decimal. 1.04 power 10. Understand the concept very clearly. Again, I'm repeating this. This is an area where final students also make a mistake. R and N. R and N should be for the time period at which cash flow is happening. If you are paying every month, tell me R per month and how many months. If it's every half year, R per half year and how many half years. Clear? Any doubts on this? This is called compound value. The question is asked, what is the compound value and compound interest? This is called compound value. Interest is how will I calculate? Yeah, 1,11,000 minus 75,000. Clear? Any doubts? And some of you look a little confused, so let me know if there is a doubt. Any doubts? Okay, please get me the revised value if it's compounded quarterly. If it's quarterly compounding, like semi-annual, it's quarterly now. Get me the revised answer. Compounded quarterly. It is compounded quarterly. What is the rate of interest now? 2%. Number of periods into what? 1.486. So value increases to 1 lakh 11 450 and 36. Normally, higher the frequency of compounding, I'll be more happy about it. If can be monthly, I'll be more happy because my income will further go up. What is indirectly happening is if you do quarterly or half yearly in between, you earn more interest on interest. You earn interest on interest. You see here in this calculation, when I said I initially earned 1,000, but next month I'm earning 1,010. That extra 10 is interest on interest. That extra amount is interest on interest. This will keep happening this way. Any doubts on this? Clear? Done. So with this, my time value of money discussion is over. Beyond this only I can start with proper CA Inter area. This is what we would have done at CA Foundation. Just to recap that, I had to spend this time. So we have learned 4-5 concepts. One is called present value, which is today's value. Future values, tomorrow's value. Present values into PVF. future values into future value factor. For an annuity, you will use future value annuity factor, present value annuity factor. For immediate, you will have to do into 1 plus R at both the places. Perpetuity is equal to perpetuity amount divided by rate of interest minus the growth rate. And last part we learned effective rate of interest, which is basically based on the compounding frequency. My effective rate of interest income can go up 1 plus R the whole power n minus 1. Clear? Any doubts on this? Clear? Okay, let's take a break of 15 minutes.